Well, there's a signature tune for our man on banking, financial services, and anything else to do with investing in those areas, Kokkie Kooyman. And to today's big interview, Kokkie is going to be taking us through, well, you had a chance to read and to listen and to watch the interviews that I had with 5 of the South African premier banking leaders over the last month. We also, Kokkie, have had the first set of financial results coming out from the US, first set of quarterlies from the 2 big banks there. And of course, Sean Pesh, one of your ex-colleagues, I think at one stage.
That's right.
Was saying if you can't buy Europe today, you can't ever buy Europe. And he says it's just so cheap. And I guess it'll be lovely to pick up on banking stocks there. Amongst them is a Greek bank that one of our correspondents has got very excited about, and look forward to getting your views on that. But let's start off with those interviews. It's always good for me to be able to talk with the CEOs after the financial results have been released. And we had the privilege one day of having Ari Rotenbach in the studio, the CEO of ABSA, on the Thursday, I think it was. And then on the Friday, we had Alan Pullinger, the CEO of FirstRand, in the studio. And my goodness, the contrast between the two, the cultures of the two, the way the two came across to me was stark. But maybe give us your insights.
Yeah, I really enjoyed those interviews as well. And I must say, if I can congratulate you on your birthday, but also just quickly, it is so exciting to watch how your membership and what you're doing has grown. And you'll remember those early years with David Shapiro, Piet Viljoen, and the interviews then. But okay, it's fantastic. And thank you for still thinking of me. So on the interviews, what really struck me, as you say, of those first 2, on the Ari and Alan, that both of them emphasized the importance of culture and what they're doing to ensure that the teams below them as CEO think with them and work with them and for the group as a whole. So FirstRand, because of Laurie, GT, Paul have established that owner management culture much more. It's longer ingrained. But so for the new CEO, all it really is about ensuring that the franchise that's been built up maintains that momentum of growing market share profitably. And you can only do that when the top team thinks alike. And I think both of them, emphasize the importance and what they do. I really enjoyed that part. Ari was very interesting as well, because obviously he had the positive or of post or during the Barclays separation, pulling his team together at a low point. And, when a team pulls together, and we've been conversing about this last few years as to how they were succeeding and how initially there were risks, but now when a team has pulled together and they're seeing the fruits of what they've done, you can see it's now they're really working together well. So I think ABSA still, the momentum is behind them, the benefits of that separation. I must say, until listening to that interview, I didn't realize how really powerful it's been and how, being released of that burden, and now can focus on client service. And then obviously your interview with Capitec, Gerrie, is always, that's just an amazing franchise. And, and their focus has really been, and that came across again in that interview, on just client satisfaction levels. And so, to round that off, Nedbank, Mike Brown and his team have really focused the last year, 18 months, 24 longer actually, on digitalization. And so what Mike said very nicely, end-to-end refreshment, nice term, of your front end and your back end. And that's really what I think bank investors are missing. We get to Europe just now as well, is how banks have taken out a lot of the so-called middleware. All those processes at head office where pieces of paper were filed and refiled and then sent from A to B and inbox and outbox. A lot of that's been taken away, and at the end of the process, all will be taken away. So you have a digital app which the client uses, which goes straight into the computer, and and then gets exercised. Yeah, Michael Jordan, actually at the UBS conference last week, said that Bank Zero now can upload, or you can upload as a partnership or small business, the KYCs, the requirements of all your directors from your office. You don't have to go into a branch, and you know how laborious that KYC process. So they've gone out of the way, everything to freshen the front end of where the client interacts. And I think that's really the change of banking. And then Standard Bank, as some said, they've got now 40% of earnings coming from outside South Africa, mainly Africa, and that should be 50. Now, when you talk to international investors, they all buy Standard Bank because they see it as the best proxy. They see it as the best proxy for Africa. So you're actually buying, if you think there's going to be a commodity cycle, you buy a Standard Bank. The problem for them at the moment is just the whole Liberty integration, which I think is going to be more difficult than they anticipate. And then Africa, I don't know if you saw, Nigeria is thinking of restructuring its debt. You know, African countries are really battling with the high inflation, the stronger dollar. Ghana has now got an inflation rate of 36%. So Sim and his team and Arno and guys are trying to drive that, but individual countries all going through problems. So, but I really enjoyed those interviews. And actually the bottom line is when you look at the ratios, we'll compare them just not to the European banks. Our banks are amongst the best in the world, all of them.
It's so interesting to hear your views, particularly when it's a little bit like I have a warm spot for the horse racing industry. And I can remember going to horse sales, and you could see the best way to pick a horse would be to see them walking together in the ring when they went for their walks, or just before they went into being auctioned, because you could directly compare them. And in this way, directly comparing the banks, it seems as though they all have their good points and their bad points, or I suppose you should say their challenges. But generally speaking, South African banks, I was impressed with. There wasn't one of them that I could say to you, "Oh, Kokkie, I'm worried about this one. The CEO didn't really have his finger on the pulse," or maybe they haven't really got their balance sheet as clean as it should be. It's almost like they're sitting in a position now where in the last 10 years, they've cleaned up what there is to clean up. And they're just waiting for maybe some wind to pick up from behind to give them that turbo boost to their earnings, to their profits, and of course to the share price.
Yeah. No, interesting again from the interview with Ari, what came out, because you started off on that, on you working for Absa in Singapore many, many years ago, and where are they now? And if you think of the big four, all followed a different strategy upon realizing that South Africa might go X growth or lower growth. And how do we use the knowledge and expertise we've built up most efficiently, allocate capital? And so First Rand have always been, that's just all Lowry and Paul and GT were so-called briefcase bankers. They never wanted to have branches or operations in Africa or in other countries, and flew in and out. And then finally made that acquisition, the purchase of Aldermore in UK. Obviously, they had Motonova and so beforehand, and that's going to be interesting to see how that plays out, especially now with what's happening in the UK. But I think they will mostly now, having got a strong foothold there, maybe use that opportunity to add to that. But Standard Bank obviously went the opposite, and it started many, many, many years before, where they went branch and commercial investment banking route, where you had a flag in each country with a head office with branches. And so that's over time works, but it's very capital intensive. But that's behind them. But it's going to be interesting to see if they can really make it work. And then Absa, now at the moment, got a very good operation in Mozambique and some of the other southern African countries, but now want to service their corporate clients with, as he said, open a branch in New York again, post Barclays, London, thinking of Singapore, China. But it says that at the moment they won't grow a client base that way, because you can't grow clients in New York or London. You can only service your existing clients better and hope you can gain clients that way. So in terms of growth outside of South Africa, maybe apps are the furthest behind. But at the moment, that might give them the opportunity. Now, well, he referred to that they would think of adding to what they've got. And Nedbank, when what is easiest in terms of management, but most difficult, buying the 20% stake in a banking group which has presence in, I forget now exactly how many, 10 Western African countries. But then you're dependent on those guys to do it for you. But so it's, and Capitec, obviously, every time you ask Ferry Fourie, he says, and Rian Stassen as well, we've got so much growth, so much market share we can take in South Africa. We don't need to think about offshore except that clean finance. But they did that more to get a ringside seat in Eastern Europe, to have interface with regulators there, but a small stake in someone else doing it for them. So the expansion strategies of each are actually very interesting.
It's an interesting story, and I guess the more that our community understands the opportunity that exists in buying banking shares, the more they're going to follow those stories and the differences between them. The one big question, though, overshadowing all of this is the potential grey listing. Now, I know Sim Shabalala did wave a flag at this. How serious is it, Kokkie? How close are we to getting a grey listing? And indeed, if Magnus Haystack is right and we do get a grey listing, are we going to see a market crash here in South Africa?
Magnus, the nature of the beast, will always want to see the worst case for South Africa, and it's never that bad as he paints, and it's never as good as some of the other. But grey listing will be a negative. It will affect everybody, and I'm not sure if your listeners are all up to date, but the problem areas for us at the moment is not so much the large banks, because their systems have been upgraded and interact very well with the FIC, etc. It's the property guys who buy and sell property. Let's say your Goldings and your Pan Goldings who allow foreigners to buy local property, and so you can whitewash money that way. Gold coin exchange. It's those type of peripheral areas where it seems the biggest risk is of money coming in and out of the country and financing terrorism, according to the international authorities. And to get the legislation in place for that, it seems what is taking the time now. So, but if we do get grey listed, sure, it is true, there will be greater scrutiny of every foreign transaction enforced by the international authorities, because they will elevate the risk status of South Africa in the corresponding bank. So if I want to, let's say, transfer money to ING, then suddenly ING says, here's a South African recipient, I've got to double the scrutiny, else I'm going to be in trouble with my own central bank. And so the cost of doing business, especially in terms of exports and imports in South Africa, will increase. I don't think it will be as dramatic, but there will be a negative effect, a further drag on, if you think of it, the most important thing that's, that to grow jobs, you want capital to be put into businesses in South Africa, and that capital becomes more expensive, so your hurdle rate goes up, and then you might just rather sit with the money in government bonds, which, by the way, is not risk-free, but you can earn 10% in government bonds. Why should I go and risk that starting a business when the cost of doing that is increasing? And that's the negative of grey listing.
So putting it all together, can we still buy South African banks? And if so, what are your favorites?
Alec, we far past the point globally as well. The banks have lagged in South Africa. They have actually done relatively well, but obviously not in dollar terms. But globally as well, banks have been sold off so far that the valuations are really attractive. And I think what most investors miss is the post-2008 regulatory changes. So it's banks hold double, I checked up again before this interview, they hold 2.5, 3 times the amount of capital they held in 2008. Their books are much more diversified. The loan losses are a lot less. So they're in a safer space. They're benefiting from higher interest rates. So the only thing is, if you just think of it just longer term, traditionally, you don't want to own banks in the run-up to a recession because you don't know how bad the bad debts are going to be. Banks are investment vehicles you buy in when the recovery starts. Because that's really when you get strong loan growth, the bad debts fall. So this time it is different. The banks fell in anticipation, but interest rates are going up much, much more. So your income statement, interest benefit is high, but the bad debt charge is not coming through. The negative is not coming through. And so that's why I think you could wait until we see the global recession ending, which might be 6-9 months. But you could miss out as the market realizes, as with these results coming through now, that what I'm saying is correct in that bad debts are not going to be a problem. They are super cheap, and the market starts buying them ahead of the upturn.
So the South African
so which ones?
Mm-hmm.
Which ones? Now I would still look. If you look at the valuations, Standard Bank and Absa are now about the same valuation. Was it 1.2 times? 1.121, 1.19. Absa is going to initially generate a higher ROE for you, most probably a better dividend. And I think it solved most of its problems, where Standard Bank is still grappling with some of the problems, Liberty, growing retail into, especially the wealth network into Africa. So I would still prefer Standard Bank. And then, Capitec.
Did you say
Absa, did I say Standard Bank?
You said Standard Bank, yeah.
Okay. I'll say that when I say Sim, when I see Sim next time. No, I'll tell him as well. I think they realize but they're working at it. Make no mistake. I mean, it's not as if they're sitting asleep there. But Absa is the best benefits from this cycle, is doing well. FirstRand is just that ship that you own. They're just pumping away, and you just and then Capitec, it is expensive, but it's always expensive. And just going through the numbers now again, it is, all these deals they're doing now, getting a life license will take 4 or 5 years before you see the benefit of that. But to deal with easy equities, the funeral policies, now the business banking, I think that's going to really kick in. You listen again to your interview with Gerrie. He actually gave you that hint. He said, just check business banking. It will all be visible by April, and then really the results will come through. So Capitec is one of those you just buy and you keep it there for your children and later your grandchildren. And they look back and say, a bit like Remgro was in, the grandchildren will say, yes, my dad was clever buying those Capitecs.
Let's move on to the Greek bank that was passed on to me by one of our correspondents who lives in Greece. And he's I don't want to name him, but he was an investment analyst, well known to South Africans. He said to me, have a look at Piraeus Bank, because tell us Mr. Cardis, I think that's the way you pronounce it, who left Glencore. He was one of Ivan Glazenberg's lieutenants there, head of the copper division. He left there end of 2018, obviously with a lot of money. He's become one of the biggest investors in this bank. It's trading at 20% of book value. So what that means in simple terms is that if you were liquidating the bank today, you would get 5 times as much for your money than you invest at the current share price. It looks irresistible, Kokkie, is it?
It is. You've got to be a Greek to love a Greek bank. No, undoubtedly, it's there are 3 big banks in Greece. It's Alpha Bank, Piraeus, and the National Bank of Greece. National Bank of Greece is a state-owned bank. So Alpha and Piraeus have been fast and moving. So when you compare Piraeus to, let's say, the rest of Europe, you can get Commerzbank in Germany at a similar valuation, 0.3 times price to book, so 70% discount. You can Standard Charter, the whole of Standard Charter internationally at a similar valuation. You get SocGen and Société Générale, as the French say, and BNP Paribas at 0.3. And the advantage of SocGen, BNP over the Greek banks is they pay very high dividends. Okay, so why what is there? Look, by the way, Piraeus and Alpha, both great banks, and their managements have done very well. In our global financial fund, we've been looking at them, visited them a few times and see managements at conference. So why have we not invested? Why have we preferred SocGen and like ING? It's more with the risk environment. So Greece's national debt to GDP is still 170%. Granted, in 2020, no, earlier back, about 5 years before that, it was 270%. So the Greek debt is coming down. But in an environment where interest rates are rising sharply, the risk is that affects their income statement, their budget negatively. Then the banks, Piraeus itself sits, I think it's non-performing loans are still 12% of the total loan book. In most banks, South Africans, it's about 3%. So there's a large part of the loans that are not income generating. By the way, that was 70% after the Greek crisis. Can you believe it? That shows you what can go wrong with banking if a country defaults. So positive for management. They've really worked hard. They brought in non-performing loans back from 70% to 12% by obviously selling off assets. But to go further, they actually need the Greek economy to continue growing strongly, which if it wasn't just for the hike in interest rate cycles, I would believe it. But if the Greek economy stumbles again, you can't sell those assets, the non-performing loans on your books. Whereas SocGen and BNP Paribas haven't got exactly that same problem, and you can get at similar valuation. So for the Greek banks, I think they will all unlock. Pesci is right. I mean, in our global financial fund, the biggest problem we sit with now, the argument between all the analysts is, do we move more money into the US banks, which have also come down a lot, not as cheap as European banks, but are not as at risk. But then what Pesha isn't saying, and I'm sure he knows it, is that the European banks are much more geared to higher interest rates. So I think the Q3 results are going to be published in the next 3 or 4 weeks, are really going to show strong interest income growing. And again, as your bad debt's flat. So I think the market short term wouldn't be surprised if the European banks, including Piraeus, most probably just beat the US banks in terms of price performance because they are very, very cheap. The bad debt's going to be less than thought. But your interest income is going to push you. So the risk for Europe is more, let's say, come November, December, when it gets cold and Russia turns off the gas and, and that you then go into a recession. And that's why markets are waiting a bit with the European banks. So if you haven't got FOMO, and when you look at the stats, you want FOMO, you want to actually then you wait maybe till February, you'll have a better, clearer indication of what's happening in Europe. So the banks are fine, but if Europe really goes into a bad recession, which it could, then you might have time to wait. But you are getting a 6% dividend yield on most of the European banks at the moment. So, yeah.
There's a lot of downside protection there as well. And
Quite.
I guess as you and Pete have taught us at the Berkshire Hathaway AGM, listen to what Warren Buffett says, buy low if you can. And that's got to be the time when stocks are cheap. What about the results, the quarterlies that came out in the United States on Friday from JP Morgan and Morgan Stanley? They were very different. And of course, we've got other big banks from the US who are going to be reporting soon.
Yeah. You saw US Bancorp and Citi reporting as well. Morgan Stanley disappointed a bit. So what we mustn't always bear in mind when you look at US banks, you've got the investment banks, or the predominantly investment bank, like JP Morgan, Morgan Stanley, Goldman Sachs, Bank of America. So Bank of America, JP Morgan have a large predominant investment bank, but there's a large amount of Chase Manhattan as a commercial bank. The credit card is a credit card bank as well. There's something like US Bank or PNC are predominantly general banking. So their earnings are less volatile, whereas your investment banks, obviously, when market activity is down, as it was in last quarter and maybe this quarter, their earnings are down. And so that's disappointing Morgan Stanley. The market making activity and the investment banking disappointed. Whereas JP Morgan came through fairly good. Fee income was less, but operation expenditure control well. Interest income did well, and it's trading at 1x book, so not the 70% discount Piraeus. So, but your return on capital is, let's say, 11-12%, where Piraeus is doing a return on capital of, I think it's, well, last year was negative still, but it's 5% forecast. So it's a tough one. But the bank's results confirmed what I've been saying, that interest income is strong, your operational expenditure is fairly well controlled. Fee income is going to be the volatile one now.
All right, so let's pull it all together to close off this update with you. And thanks again, Kokkie Kooyman from Denker Capital, for sharing your wisdom with us. You've said that in South Africa, Capitec, FirstRand, and Absa are the ones to have in your portfolio, and they will be in the BizNews portfolio at the end of the month. We've already got 2 in there, but we'll be adding Capitec for sure. As far as the international banks are concerned, would you be rather buying into those? And if so, the SocGens, the stocks that you've suggested to us now, or would you be looking to across the water to America because of the potentially higher growth rate you'd see there?
Yeah, I would. The environment we are in at the moment is there's so many different risks and so much volatility that I would diversify a bit more. So I would buy a SocGen now, which does have risk, but extremely attractive valuation. We could go BNP Paribas, but remember, both are investment banks and could come with disappointing results now. But the retail franchise, what you've got to look at, what they're doing, and that's actually growing strongly. So, and you're getting a very good dividend yield. You could go safe and go for ING in the Netherlands, which hasn't got investment banking. But I'd buy that and maybe buy something like JP Morgan. It's trading at book, which is always a good entry point. And if the war really escalates, if it does develop into a World War III, which really most grateful that it doesn't happen, but then America is far away from the war, where Europe, so you're in a way buying Europe now. You are taking a bet that the war doesn't escalate.
And Piraeus as a wild card?
As a wild card, I'm very tempted myself in the portfolio. My analyst is resisting me. He says we've got enough risk in Europe. But, what happens with situations like Piraeus, and the momentum is behind them. You can see how they've gradually been improving. Normally that continues. So, I would say they're going to surprise positively again on collection of bad debts, of gradually improving the return on capital. But then you are betting as well that Greece doesn't go deteriorate, and that the Greek government also keeps doing the right things. So as a wild card, the valuation is such, and the momentum behind the team, and they have got a track record now of delivering, is good.
Kokkie Kooyman from Denker Capital, and I'm Alec Hogg from BizNews.com.